Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is David Howard, and David is a tax attorney. He has his own legal practice in Campbell, California. David's been both a lawyer and a CPA for more than 40 years, only yesterday. And he used to be a tax partner with Deloitte LLP. He was a tax partner there for over 20 years. And at Deloitte, he developed tax strategies for multinational corporations, Silicon Valley startups, family corporations, corporate executives, and wealthy individuals. And his former clients encouraged him to return to practice after he had retired from Deloitte. He has taught extensively, including for the California CPA Society, New York University Tax Institute, San Jose State Masters in Taxation Program, and much more. Last year he did a presentation for our local Kasner Estate Planning Institute. Yeah. Now lately David's law practice is focused on helping clients get in compliance with the information reporting requirements for offshore financial accounts, trusts, and gifts from foreign sources on the applicable forms, which we call the FBAR form, 8938, 3520, 3520A, 5471. They've got a lot of these forms that you need to do these disclosures on, we'll be talking about. And anyway, so he's dealt with a lot of well-meaning individuals who, for some reason, didn't file these forms on time. And now, over the last several years, have had to deal with potential penalties. So he's done a lot of cleanup on this sort of stuff. And so we just want to alert our viewers about these issues. David also, though, does other tax law work. He told me that he's currently working on 10 tax court cases. They're all related, I guess, but still, that represents a big amount of work that he's getting to wrestle with. Dave, thanks for joining me today.
My pleasure.
Okay. Also, Dave is one of my favorite people, and he is an extremely creative individual, and so he does come up with wonderful ideas for people's tax planning. Okay, well, Dave, how do I know if I have an unreported foreign account from prior years?
Well, that's a good question, because some people have no clue that they do. If you have an account outside of the United States, but it's with a U.S. bank branch, that may not be considered a foreign account. On the other hand, if you have a deposit in a foreign bank, that's generally going to be considered to be an offshore account and needs to be disclosed. And what happens is that if the balance is under $10,000, if you add up all your offshore accounts, and in fact, you should not assume that any bank outside of the United States is going to be considered a U.S. bank. Don't make that assumption at all. But if your foreign deposits, the highest balance in every account, you add them all up, and if they're more than $10,000, you should have been disclosing them.
Yeah, anytime during the particular taxable year.
Right, just that you take the highest balance in each of these accounts in dollars, add them all together, and if they're more than 10,000 and you've not been disclosing it, you have an undisclosed foreign bank account.
Right, and we're not just talking about bank accounts. So also now banks, I think, also function as brokerages overseas. And
right, so if you have a brokerage account or an investment account abroad, you need to disclose that. And of course, they've reached out to even further types of financial assets, including life insurance policy that has a cash surrender value. And so I had some clients that had, they were working with an American, now that's where you get very confused. You're working with an American brokerage firm outside of the United States. You think you're dealing with a U.S. company, but if they're outside the United States, they're viewed as a foreign company. And I believe it was Prudential. These folks were in Indonesia. They're dealing with Prudential, our good, solid as the rock insurance company, Rock of Gibraltar. They bought a life insurance policy with cash surrender value. Well, that's a foreign asset, foreign financial asset, that now has to be disclosed. You don't do it on an FBAR, though. It's on the 8938.
Okay.
It's where you disclose that kind of thing, but which is confusing, all the different disclosure forms and how they overlap. Well, certainly a couple of them do overlap quite
Oh
a
yeah,
bit.
well, especially those two forms.
Yeah, yeah.
Now, also, if you have like a foreign retirement account,
Oh, that's a big trap because
yeah, like
most,
an IRA, like
yeah.
a foreign IRA type thing, or
Yeah,
whatever.
no, yeah, you're dead meat because now I'll tell you the people that really get caught on that are our Canadian friends,
Uh-huh.
the Canadian Americans that have gone to Canada and they've worked, they come back here and live and they left behind a Canadian retirement account and they think it's just like an IRA or a 401k here. It's not. Those plans are not qualified in America. It is taxable income. And if you are a U.S. citizen when you were living in Canada, you should have been reporting that as additional income as well and disclosing the account. So there are a lot of Canadians, Americans who lived in Canada or Canadians who now live in the U.S., have green cards, file U.S. income tax returns, and forget about including their retirement accounts. But people from all over the world, Australians, Brits, and everywhere, you have these retirement accounts. You come to America, you need to report those things.
Yeah. So part of the problem is that, we have a global economy now, and we have a lot more movement of people among the countries than we once did, and particularly here in Silicon Valley.
Oh yeah.
So we have people from all over the world who work here, and with green cards or whatever.
Yeah.
And so they sort of bring their baggage, and we're a unique country in this disclosure thing. So if you are a German, I had German citizens that had come here. They were flabbergasted when I told them about the reporting rules and that they had to report their worldwide income and so forth, because in Germany it doesn't work that way.
Right,
and their income tax reporting system is pretty much a withholding system. So
yeah. Well, no, you're right. Every country in the world except us, if you leave your country and you have no other income inside of that country, now if you had a savings account or brokerage account or something, that may be taxed locally. But if you took what you do is you put that account in the island of Jersey or some tax-free jurisdiction, which is totally legal, and you leave your regular country of domicile, you pay no income tax at all. But in America, now we're so far to the opposite. If you were, Bruce Lee, the karate actor, when his mother was pregnant with him, she was visiting San Francisco.
Right.
He was born here,
Right.
and I guess they lived here, 6 weeks, and then he goes back home, and he grew up in wherever it was, Hong Kong.
Yes.
Well, the fact he was born here made him a U.S. citizen.
Correct.
Once you're a U.S. citizen, you must report your worldwide income all the rest of your life and pay federal income tax on that.
Right.
There's no other country that does that at all.
Right.
And now they do have the Bruce Lee exemption, where they only charge you a 5% penalty for not disclosing. If you didn't know you're a U.S. citizen.
Yeah.
They've also lowered the penalties for people residing abroad who are U.S. citizens and are just totally unaware of the fact that they should have been filing U.S. returns. I had a client, a very nice woman, who was a dual citizen of Mexico and the United States. And she grew up in Mexico City. She got her citizenship because her parents were U.S. citizens. She spoke English at home, and now she came, in her about 30 years old, she comes to America to live, and she finds out that all those years she is living in Mexico, she should have been filing a U.S. income tax return.
Yeah.
Now, these kind of people the system is sympathetic to this kind of a situation,
Okay.
but it is a mess to get straightened out.
Yeah, no kidding. So I had another friend, and his children are living in New Zealand. And because their mother moved back there, he's living here. They're divorced, I guess. And anyway, so I met these teenage girls who were delightful. They're getting ready to come to the U.S. to go to university. I'm thinking to myself, these kids don't have a clue.
Yep.
Yeah.
No, you just you can really get yourself much deeper into our tax system than you want to. And actually, under the statutory scheme of things, you become a U.S. taxpayer just by physical presence. And they have that, you count up the number of days this
Right.
year, last year, and the year before. And if they add up to 183, you are a U.S. tax resident. You have to file the return. So
Right.
you go back, 2 years back, and you count, every day counts as 1/3 of a day. You go back last year, every day counts as 2/3 of a day, plus the days this year count as a whole day. So if all those add up to 183, you're a U.S. taxpayer.
Right.
Now there are treaty exemptions.
Right. And that's what I was thinking of, like the students have a.
So you may,
special exemption.
but this stuff's complicated stuff.
Oh,
It's-
yeah.
It's ridiculous because we have this notion, for some reason our country, I think Democrats and Republicans both think that anybody with a foreign bank account or any foreigner is getting away with something tax-wise. And they keep passing laws on top of laws. That's why we have the 8938, this FATCA thing, disclosure stuff that layers in on top of the FBAR disclosures. And it just makes it a very confusing mishmash of things that
Right.
you have to deal with.
But your threshold for the 8938 is a lot higher.
Right, the 8938, there's a rule, if you're married filing jointly, what's it, like 150,000 in foreign assets, and if you're married filing, or if you're single, it's like 75,000. But again, it's this high watermark, so you have to look
Yeah.
back through.
Yes, you have to look through the year.
And I'll tell you where else you have to disclose it. On your 1040 Schedule B,
Right.
right
There's
at
a
the
question,
bottom,
yeah.
it says, do you have foreign bank accounts? Did you file the appropriate forms? You got to answer that. That's very important.
Yeah.
And you attach the 8938 to your tax return.
Right.
Whereas the FBAR, the foreign bank account disclosure, is separately filed electronically.
Right.
And you can't extend it. It's due June 30th of every year.
Okay. So we're already 15 minutes into this thing.
Really? Oh my gosh.
Isn't that amazing?
Yeah.
So let's talk a little bit about gifts for a few minutes, because we've been mostly talking about other assets. So what sort of things do people, because we have people here, I get calls from people from time to time. Yeah, hi, I'm here, I've been going to school and I'm working here in Silicon Valley, and my parents live in India and they want to send me a couple $100,000 to help me buy a house.
Yeah, okay. That's okay. So now, one, is that subject to U.S. income tax? No, it's not. It's a gift from a foreign source. Does it have to be disclosed? Yes. And now, if you read the code, any gift over about, I don't know, can't remember what it is, like $12,000 or something, you have to disclose. But the IRS has held that if it's a gift from a foreign person and it's over $100,000, you do have to disclose it on a Form 3520. Just disclose it. If you don't disclose it, the penalty could be as much as 35% of the gift, so for not disclosing. But if you disclose it, it's okay. Now, if the gift is from a foreign partnership or a foreign corporation and it's over about 10,000 or inflation adjusted, it's a very low number, then you do have to disclose it as well. And what they're looking to see is that a disguised dividend? Is it a disguised income distribution? They want to make sure of that. But otherwise, a foreign gift, you just disclose it. And there's nothing bad about a foreign gift.
Now, they can sometimes be subject to gift tax, I understand, if the transfer happens in the U.S. and there's a question like if they wire money or that sort of stuff, I guess. So the best thing to do, I understand, is to have the child, for example, if they're receiving the gift, set up a foreign account offshore to receive the money over there, and then bring the money over
Well,
here.
it's actually hilarious. Well, I don't know if it's hilarious. It's an awful pitfall. Your parents are visiting you from India, and they hand you American cash.
Yeah, well, that's a reportable transaction.
Well, excuse me. They may have had to disclose that they brought that much cash into the country, and that could be an issue. But aside from that, if they deliver cash to you, that's probably not going to be subject to gift tax. But if they write you a check can meet the test of being personal property that was transferred. So if there's a transfer of personal property to you in the U.S., that could subject your parents to the gift tax. So they should make, now if you're in India and they hand you the gift, no problem. But if somebody comes over here, it's a problem. Another thing if the parents bought the real estate and then gave the gift,
Oh,
the
yeah.
gift of real estate is
Yeah.
subject to gift tax.
Absolutely.
And
Absolutely. That's
so,
U.S. property.
so what you do is you form an offshore LLC. You can go to the British Virgin Islands. You form an LLC to own real estate in the United States, and you elect to have that LLC taxed as if it were a U.S. entity, and it could be and so you're not playing any games with income tax, but the owner of that real estate just owns an interest in this foreign LLC, and that is not considered to be real estate, and so they could give away the interest in the LLC to their kids. That wouldn't be a taxable gift here. But it's kind of tricky. I have clients where the husband's a U.S. citizen. He married a very nice woman from China, saying she's not a U.S. citizen. They buy a house. Well, her interest in that U.S. real estate is going to subject her estate to U.S. estate taxes. And if they're not going to live here a long time, she may not want that to happen. So, you say, well, husband and wife, they buy a nice house here, they got to set up an LLC in the Virgin. It gets too complicated. But it just depends what the dollars are.
Okay. So, anyway, but the other thing, and it's really not intended to be for us to be in a estate and gift discussion here, but the thresholds for we don't have a $5 million exemption for foreign persons.
No, that's another one. So I had a guy come in and he said, well, my father, who's not a U.S. citizen, lives in Greece, someplace, didn't know what to do with his money. And I said, well, buy some Fidelity funds. Holy smokes, he buys Fidelity mutual funds. He has $5 million in there. When the father dies, the exemption's $60,000.
Right, and it's subject to U.S. estate tax because of the U.S. securities.
Yeah, right, absolutely. And so that's 44 or whatever, the 45% estate tax. And the guy said, oh my God, you mean my father who's never stepped foot in America is going to have to pay 45% of everything over 60? I said, well, yes, that's why you set up an entity in the Cayman Islands. That's totally legitimate. You set up an offshore company that owns it. You pay all the U.S. taxes, but you avoid that estate tax. And
to our viewers, I hope you can
follow.
See now, why David is an extremely valuable person to know for knowing these offshore structures and so forth. I've known Dave for years, and whenever I was trying to get in touch with him, he said, "Oh, he's back in Geneva again." He spent a good part of his time overseas. So anyway, and then the other thing is that when he left Deloitte, the people, I understand, were unwinding a lot of the things that he set up because they didn't understand what he was doing. That
breaks my heart because and we always did things that worked. In other words, I don't like to break any laws,
right.
but you can kind of stay ahead of the laws. I used to always tell my clients, I said, this will work about 3 years, and then they'll outlaw it, and or they'll grandfather it. But sometimes they're complicated. And I need to make economic sense. I don't believe in one-of transactions just to try to recharacterize things. But if it all makes sense, there are interesting things you can do.
Okay, let's talk for a few minutes about people who make investments in offshore companies. So I was telling you about one of my clients that recently became involved as not only a shareholder, because basically it's a R&D type operation. They're trying to develop the products and so forth and get into the United States for distribution and so on. And so they gave this guy some stock and said, we want you to be an officer in our company, to get this thing going here. So what kind of reporting requirements does this guy have to deal with?
If you're an officer of a foreign company, 5471, you have to disclose the fact that you're an officer in the company, and you're just letting the IRS know. But if you don't do that, a big penalty, probably $10,000 a year penalty for not disclosing. I'll tell you another one. You think of foreign controlled corporations, that U.S. owners of a foreign corporation will, if it's owned by a certain percentage of U.S. shareholders, the income earned in that company may be immediately taxable in the U.S. Well, sometimes you don't realize that if you, as an investor, own 10% of a foreign company, even though no other U.S. people own it, you have to disclose that interest because you're at 10%. It's a one-time disclosure. But if you have an indirect ownership interest and a direct, you add them together. So you might own some stock in a U.S. company that owns some interest in that company, and your pro rata share comes back to you. But then once you file, if you keep getting more and more, and you accumulate another 10% ownership interest, you have to file again. Yeah. And so you have to track each time on a cumulative basis, you get another 10. Then you don't have to report, and then you get another 10. And then you got to watch who the other shareholders are. It's really kind of tricky, and people fall into the trap. They don't realize.
Yeah. And sometimes the reporting requirements are, I was amazed as I was taking care of this for this person, how extensive the disclosures were. And so, they want a balance sheet, they want a P&L, income statement. They want a list of the other shareholders, even the foreign shareholders.
Yeah.
They want everything.
Yeah, we're the only country in the world that's just so overreach, and it's really unfortunate. We think that that's right. Like, American politicians villainize Google and Apple for leaving foreign earnings abroad. Well, they've been taxed abroad, and every other country in the world, they just let you bring those profits home. They've been taxed. Mm-hmm. Not in America. If you bring them home, you have to pay the U.S. tax on it. They'll give you some credits for it, but again, I used to advise a lot of foreign companies, and they just wouldn't understand that. If you're a Swiss company and you have a wholly owned company operating, well, like Nestle. Nestle's a Swiss company, and they
right.
own Nestle US. Mm-hmm. All the dividends, all the interest that's paid back to them, it's tax-free in Switzerland. Mm-hmm. But in America, it's just the other way around. And not only that, the Obama administration just issued some horrible regulations on income stripping by charging interest to your foreign subs, if a foreign company charges their U.S. subsidiary interest and they pay the interest back, they'll say, oh, you're stripping the income out. We want to recharacterize the debt as equity and make that a dividend so you don't get a tax deduction. We're not very fair. Just not fair. And I'll tell you another one.
And people wonder why people want to move their operations offshore.
But here's something interesting. If you're a foreign person and you invest in say, an LLC in certain countries, as states, New York, there are a whole list of states that, or even the U.S., and now the foreign country wants the United States to disclose who the shareholders are of a company or the bank account. We don't disclose anything, even though we have FATCA, which forces foreign
right.
banks to disclose the earnings of U.S. citizens. We do not reciprocate. We don't provide the information back out the other way.
Well,
so we're a tax haven for foreigners who are hiding money here. And,
interesting.
And that's not fair either. And,
it's crazy.
It is crazy. And but anyway, go ahead if you have another question. Or I don't know where we stand.
Well, it's okay. Well, we only have about 3 minutes left here.
Oh my!
Kind of amazing.
Yeah. So it's a fun chat, really, for me. I don't know if it's fun for anybody else. But,
yeah. So when you have these people that call you and they say, I think I might have a problem here, what are some things that you do?
Well, that's a really good question. First of all, I want to know how much it is that they're talking about, because at the end of the day, the IRS wants you to report the income on your foreign bank account. It's the disclosing the account is just to let them know, to give them a heads up. But if you have an account that's earning $2,000 a year interest, you haven't been disclosing it, you haven't been picking up the interest, for the most part, I would tell somebody like that, from now on, I have to kind of evaluate. I have to know the source of the funds. Yeah. These guys they can't have been involved in criminal activities. It's just inadvertently they did this. For the most part, the right answer is just, from now on, do it right. Tell your CPA, from now on, disclose and pick up the income. But if it's a lot of income, or if it's a big balance, what I say, $500,000 or more, then we do need to go back, pick up the income, file the amended returns, and then file the disclosure forms and beg for mercy. And you don't just file amended returns and send them in. You gather up all the amended returns for all open years, you bundle them up, you send them to Ogden with a cover letter explaining, and I'll tell you, just time after time, the foreign taxes are about equal to the U.S. taxes, and you get a tax credit. There's little additional tax due, and that's really wonderful, and it's just not a lot of money. You pay the tax, you disclose that it's a catch-up, then you file all the disclosure forms, the FBARs, et cetera. When you do those amended returns, I always get the CPA to do it because it's on his computer. You attach the 8938, the Schedule B, and so on and so forth. Make all the disclosures, and then you do the FBAR. Pretty simple. Clean it up.
Okay, we're about out of time. So I guess I will just run quick 15-second. Okay, I don't disclose this. How long before the IRS, let's just say I do start doing it right, how long before the IRS falls off their scope? They can't go back and...
Well, the statute of limitation closes on disclosure. 6-year statute applies for disclosure. Okay. So every 6 years, it goes. And if you have an account, close it down, bring the money home if you're not using it.
Dave, thanks for joining me today.
My pleasure. A lot
Folks,
of fun.
Hope that we've given you some things to think about. Maybe you want to go and see your tax attorney or CPA. Yeah. And we'll see you next time on Financial Insider Weekly.